Here's a test of your current thinking about money. Open your phone right now and count how many financial notifications, headlines, advertisements, or messages you've received in the past 24 hours. Market updates, stock alerts, crypto prices, real estate promotions, investment newsletters, influencer recommendations, banking offers, credit card deals. The number is probably staggering. And this is just one day. Multiply this by 365 days per year for decades, and you begin to understand the scale of the problem. We live in the noisiest financial environment in human history. Every minute of every day, thousands of voices are telling you what to think about money, what to buy, what to fear, what to chase. The volume is overwhelming. The contradictions are constant. One expert says buy stocks, another says sell. One influencer promotes real estate, another warns of a bubble. One headline declares a recession is imminent, the next says the economy is strong. The noise is not just loud, it's designed to be confusing, alarming, and action-inducing, because confusion and alarm drive engagement, and engagement drives profit for everyone except you. This noise is not neutral, it's actively harmful. It clouds judgment, it creates anxiety, it promotes short-term thinking, it encourages activity over patience, it makes you feel inadequate if you're not constantly doing something, and most insidiously, it makes clear thinking nearly impossible, because clear thinking requires quiet reflection and the ability to distinguish signal from noise. When everything is screaming for your attention, clarity becomes a rare and valuable commodity. The result is predictable. Most people make terrible financial decisions not because they're stupid or lazy, but because they cannot think clearly through the noise. They're bombarded with contradictory information. They're manipulated by sophisticated marketing. They're subject to social pressure and comparison. They're fed a constant diet of fear and greed. Under these conditions, making sound decisions is extraordinarily difficult. Charlie Munger often emphasized the importance of eliminating noise and focusing on what actually matters. He deliberately avoided most financial media. He didn't check stock prices constantly. He didn't react to daily news. He created an environment conducive to clear thinking, and this clarity was one of his greatest advantages. While others were overwhelmed by noise and making reactive decisions, he was thinking calmly about fundamentals and making rational choices. This is not just about investing. This is about life. Money touches everything. How you think about money affects your career choices, your consumption patterns, your stress levels, your relationships, your sense of security, and your freedom. If your thinking about money is clouded by noise, your entire life is impacted. If you can develop clarity about money despite the noise, you gain advantages that compound over a lifetime. This video is about how to think clearly about money when everything around you is designed to prevent clear thinking. We'll examine what noise is and where it comes from, why it's so effective at clouding judgment, what clear thinking about money actually looks like, and most importantly, how you can systematically develop and protect clarity despite living in a noisy world. This is not about specific investment strategies or financial products. This is about the mental frameworks and disciplines that enable sound decision-making regardless of external chaos. To think clearly about money, you must first understand what you're up against. The noise is not random. It's systematic, sophisticated, and designed to exploit your psychological vulnerabilities. Understanding the sources and mechanisms of financial noise is essential for protecting yourself against it. The first source of noise is financial media, and we need to be blunt about this. Most financial media exists to capture your attention and sell advertising, not to help you make better financial decisions. The incentives are completely misaligned with your interests. Media companies profit when you watch, click, and engage. They profit from fear and excitement, which is why coverage focuses on dramatic market movements, alarming predictions, and exciting opportunities. Consider how financial media operates. Markets go up or down every day. These movements are mostly random noise, meaningless fluctuations that tell you nothing about long-term value or appropriate strategy. But media must create content constantly, so these meaningless movements are presented as significant events requiring explanation and response. You're told why markets moved today and what it means for tomorrow. Experts are interviewed offering confident predictions. All of this creates an illusion that daily movements matter and that you need to pay attention and potentially act. This is fundamentally misleading. Daily market movements do not matter for long-term investors. The explanations for why markets moved are almost always post hoc narratives with no predictive value. The expert predictions are no better than random chance. But the effect of this coverage is to make you feel like you're missing something if you're not constantly monitoring, like you need to be reactive and engaged, like investing requires constant attention to news and market movements. The truth is the opposite. For most investors, financial news is not just useless, but actively harmful. It creates anxiety. It promotes short-term thinking. It encourages trading. It makes you feel inadequate if you're simply holding quality investments and ignoring the noise. The best thing most investors could do is stop consuming financial news entirely, but very few people have the discipline to do this. The second source of noise is social media and the influencer economy. This is a relatively new phenomenon and particularly insidious because it comes from peers or perceived peers rather than traditional authority figures. You see people claiming spectacular investment gains, promoting strategies, sharing tips, and creating an impression that getting rich through investing is easier and faster than it actually is. The problem is survivorship bias and selection bias. The people posting about their gains are not a representative sample. For every person who tripled their money in some speculative investment and is posting about it, there are many more who lost money and are silent about it. You're seeing the winners and not the losers, creating a distorted impression of what's typical or achievable. Moreover, many influencers have financial incentives to promote certain investments or strategies. They're paid by companies, they benefit from referrals, they're selling courses or services. Their apparent success might be mostly from these ancillary revenue streams rather than from the investment strategies they're promoting. But this context is often hidden or downplayed, and you're left with the impression that their strategy works when the real story is more complicated. The effect of social media noise is constant comparison and inadequacy. You see others apparently doing better than you, and you feel like you're failing or missing out. This creates pressure to take more risk, to chase trends, to try to replicate others' results. It destroys contentment with solid, boring, long-term strategies that actually work. It makes you feel stupid for doing the right thing. The third source of noise is the financial products industry. Banks, brokers, insurance companies, and investment product providers all have sophisticated marketing designed to get you to buy their products. These companies employ psychologists, behavioral scientists, and marketing experts who understand your vulnerabilities and design messages to exploit them. Consider how investment products are marketed. They emphasize past performance, even though past performance is not indicative of future results. They use complex language to create an impression of sophistication and expertise. They target your emotions, particularly fear and greed. They create urgency through limited time offers. They make you feel like you need their product to achieve your goals, when often you'd be better off with simpler, cheaper alternatives or doing nothing at all. The fundamental problem is misaligned incentives. The product provider profits when you buy their product, regardless of whether it's good for you. Their goal is to maximize sales, not to maximize your wealth. This doesn't mean everyone in the industry is acting in bad faith, but it means you cannot take their messages at face value. You must always ask, what's being sold here? What are the incentives? And is this actually in my interest? The fourth source of noise is your own psychology and the psychology of those around you. You have cognitive biases that distort your thinking. You're susceptible to herd behavior, following what others do even when it's irrational. You're prone to recency bias, overweighting recent events. You're vulnerable to confirmation bias, seeking information that confirms what you already believe. You're subject to loss aversion, feeling losses more intensely than equivalent gains. All of these psychological tendencies are amplified by noise. When you're constantly exposed to market movements, your loss aversion is triggered repeatedly. When you're surrounded by others making investment decisions, herd behavior kicks in. When you're fed a steady diet of recent market performance, recency bias dominates. The noise doesn't just provide bad information, it activates your worst psychological tendencies. Understanding these sources of noise is the first step toward defending against them. The noise is not an accident. It's systematic and sophisticated. It exists because it serves the interests of media companies, influencers, product providers, and platforms, even though it harms your interests. Recognizing this reality is essential for protecting yourself. Now that we understand what creates financial noise, let's examine what clear thinking about money actually looks like. This is not abstract. Clear thinking manifests in specific ways that we can identify and cultivate. First, clear thinking about money starts with understanding your actual goals and values. Most people have never seriously considered what they actually want money for, beyond vague notions of security and comfort. Without clarity about goals, you have no basis for decisions. You're vulnerable to every pitch, every comparison, every fear that money might solve. Clear thinking means asking, what do I actually want my money to do for me? Do I want freedom to choose how I spend my time? Do I want security against unexpected problems? Do I want to provide for my family? Do I want to retire early? Do I want to build something? Different goals suggest different strategies, and clarity about goals prevents you from being swayed by noise that's irrelevant to your actual objectives. This sounds obvious, but most people skip this step entirely. They accumulate money without clear purpose. They chase returns without knowing what the returns are for. They make decisions based on what others are doing rather than what serves their goals. This lack of clarity makes them vulnerable to noise because any message sounds potentially relevant when you don't know what you're trying to achieve. Second, clear thinking about money involves understanding basic mathematical and economic realities. You need to understand compounding, not just intellectually but deeply. You need to understand that small differences in returns or costs compound into large differences over time. You need to understand that speculation and gambling are different from investing. You need to understand that real returns matter more than nominal returns. You need to understand that risk and return are related, and you cannot eliminate risk without reducing expected returns. These are simple concepts, but most people don't truly internalize them. They know compounding exists, but don't feel its power. They know costs matter, but don't act on this knowledge. They know speculation is risky, but do it anyway. Clear thinking means not just knowing these principles, but structuring your decisions around them. Third, clear thinking about money requires understanding the limits of your own knowledge and the irreducible uncertainty of the future. You do not know what markets will do next year. You do not know which stocks will outperform. You do not know what the economy will look like in 5 years. Pretending you know these things is not confidence. It's delusion. Clear thinking means accepting uncertainty and making decisions that are robust to being wrong. It means diversifying because you don't know which investments will do best. It means avoiding excessive leverage because you don't know when volatility will strike. It means maintaining adequate emergency reserves because you don't know when you'll face unexpected expenses. It means not betting everything on your predictions being right. This acceptance of uncertainty is psychologically difficult because humans crave certainty. We want to believe we can predict and control outcomes. But in finance, this desire for certainty leads to overconfidence, excessive risk-taking, and vulnerability to anyone offering false certainty. Clear thinking means making peace with not knowing while still making sound decisions despite uncertainty. Fourth, clear thinking about money involves distinguishing between price and value, between what something costs and what it's worth to you. This applies to everything, not just investments. When you're considering any financial decision, the question is not, can I afford this? The question is this worth the price in terms of what I'm giving up? Most people think about affordability rather than value. If they have the money, they buy. But this ignores opportunity cost. Every dollar spent on one thing cannot be spent on something else or invested for future growth. Clear thinking means constantly weighing alternatives and asking whether this is the best use of resources. This applies to investments as well. The price of a stock tells you what you must pay. The value tells you what you're getting. Sometimes these align. Often they don't. Clear thinking means focusing on value rather than being anchored to price. It means not buying something just because the price has fallen or avoiding something just because the price is high. It means developing independent judgment about what things are worth. Fifth, clear thinking about money requires understanding incentives and asking whose interests are served by any advice or information you receive. When someone tells you to buy something, ask what they gain from your purchase. When media emphasizes certain stories, ask what maintains your engagement. When a strategy is promoted, ask who profits from others following it. This is not cynicism. This is rational assessment of incentives. People respond to incentives, and financial incentives are particularly powerful. You cannot evaluate information or advice without understanding the incentives behind it. This doesn't mean everyone is lying or acting in bad faith, but it means you must always consider the source and what they stand to gain. These elements of clear thinking, understanding your goals, internalizing mathematical realities, accepting uncertainty, focusing on value, and understanding incentives form a framework for making sound financial decisions. They're not complicated, but they're rare in practice because noise constantly works against them. Let's discuss specific practices and systems for maintaining clear thinking despite living in a noisy environment. This is where theory becomes practice, where understanding becomes action. The first and most powerful practice is controlling your information environment. You cannot think clearly if you're constantly consuming noise. You must be deliberate about what information you allow into your attention. This is not about ignorance. This is about being selective and protecting your mental bandwidth for what actually matters. Practically, this means severely limiting financial media consumption. For most people, consuming zero financial news would improve their investment results and reduce their stress. If that feels too extreme, limit yourself to one source, perhaps a monthly or quarterly review of economic conditions, and avoid daily or even weekly news entirely. Unsubscribe from investment newsletters unless they focus on timeless principles rather than market commentary. Delete financial news apps from your phone. Stop checking market prices except on a predetermined schedule, perhaps monthly or quarterly. These restrictions might feel uncomfortable at first. You'll feel like you're missing something important, but this feeling is precisely the problem. You're not missing anything important. You're eliminating noise that was clouding your judgment and creating anxiety without providing value. After a few weeks, you'll realize that nothing you were tracking actually mattered for your long-term strategy. The second practice is creating decision rules and frameworks before you need them. Clear thinking is hardest during emotional moments, market volatility, when you see others profiting, when you're facing losses. If you wait until these moments to decide how to respond, you'll almost certainly make poor decisions driven by emotion. Instead, create rules in advance when you're calm and rational. Write them down. Make them specific. For example, I will not sell investments unless the underlying business fundamentals have deteriorated significantly. I will not invest in anything I don't understand thoroughly. I will not change my asset allocation more than once per year. I will not buy individual stocks without writing a detailed analysis first. I will not invest based on tips or recommendations without independent research. These rules protect you from yourself. When emotions are high and noise is intense, you don't have to think. You follow your predetermined rules. This removes emotion from the decision-making process and ensures consistency with your long-term strategy. The third practice is developing and maintaining a small number of trusted information sources. Complete isolation from information is neither possible nor desirable. You need some way to understand what's happening in markets and the economy, but you should be extremely selective about sources. Look for sources that focus on principles rather than predictions, that emphasize long-term thinking rather than short-term trading, that acknowledge uncertainty rather than claiming false certainty, that have no financial incentive to promote specific actions. These sources are rare, but they exist. Once you find them, ignore everything else. Having 3 excellent sources is far better than having 30 mediocre sources, and far better than consuming everything indiscriminately. The fourth practice is regular reflection and journaling about your financial decisions. Write down major investment decisions when you make them, including your reasoning, your expected outcomes, and the alternatives you considered. Review these periodically, not to beat yourself up over mistakes, but to learn from your thinking process. Over time, you'll identify patterns in your decision-making, both good and bad, and you can adjust accordingly. This practice creates accountability and forces clarity. If you cannot articulate why you're making a decision clearly enough to write it down, you probably shouldn't make that decision. The act of writing forces you to think through your reasoning and identify weaknesses or gaps. It also creates a record that helps you distinguish between good decisions that worked out, good decisions that didn't work out, bad decisions that worked out, and bad decisions that didn't work out. This distinction is crucial for learning. The fifth practice is building relationships with people who think clearly about money rather than those who amplify noise. Your peer group influences your thinking more than you realize. If you're surrounded by people who chase trends, panic in downturns, and constantly talk about investment gains, you'll find it hard to maintain clarity. If you're surrounded by people who are patient, rational, and focused on long-term principles, their example reinforces your own clarity. This doesn't mean seeking an echo chamber where everyone agrees with you. It means finding people who think clearly and rationally, even if their specific strategies differ from yours. The key quality is clarity of thought, not agreement on every detail. The sixth practice is using checklists for major financial decisions. Before making any significant investment, spending decision, or financial commitment, go through a predetermined checklist of questions. Do I understand this thoroughly? Have I considered the opportunity cost? Am I making this decision for the right reasons? Am I being influenced by emotion or noise? Does this align with my long-term goals? What could go wrong? Can I afford to be wrong? Checklists prevent you from skipping steps in your thinking process. They force you to slow down and consider multiple perspectives. They're particularly valuable when you're excited about an opportunity or when you're under pressure to decide quickly. The checklist requires you to pause and think through the decision systematically. These practices, controlling information, creating rules in advance, curating sources, journaling, building the right relationships, and using checklists are all systems for protecting and maintaining clarity. They work because they don't rely on willpower or discipline in the moment. They structure your environment and processes so that clear thinking becomes the path of least resistance. Let's examine some specific examples of how noise clouds thinking and how clarity would change the decision. These examples illustrate the practical difference between thinking clearly and being overwhelmed by noise. Example 1. Market volatility. Markets drop 10% over 2 weeks. Financial media is full of alarming headlines about recession risks, geopolitical concerns, and investor panic. Your portfolio is down significantly. Friends are talking about losses. You're anxious and considering selling to prevent further losses. The noisy response: sell to stop the pain, move to cash, wait for things to stabilize, then reinvest when markets recover. This feels safe and prudent. You're taking action to protect yourself. The clear thinking response: recognize that short-terms volatility is normal and meaningless for long-term outcomes. Review your predetermined rules, which say you hold through volatility unless fundamentals change. Ask whether anything has fundamentally changed about your investments or your goals. If not, do nothing. If you have cash available, consider buying more at lower prices. Recognize that your anxiety is a predictable emotional response to loss, not a rational signal to change strategy. The difference in outcomes: the noisy response locks in losses and typically results in missing the recovery. The clear thinking response maintains your position and lets you benefit from the eventual recovery. Over multiple cycles, this difference compounds into dramatically different wealth outcomes. Example 2. A hot investment trend, cryptocurrency or cannabis stocks or whatever is currently surging. You see constant media coverage. Friends are making money. Social media is full of success stories. You feel like you're missing out. You're considering investing a significant amount despite not really understanding the investment. The noisy response: buy to avoid missing out. Rationalize that you'll learn as you go. Invest more than you can afford to lose. Check prices constantly. Feel vindicated if it goes up, anxious if it goes down. Eventually sell, often at a loss or after missing the peak. The clear thinking response: acknowledge the feeling of missing out, but recognize it as an emotional response, not a rational signal. Apply your rule about not investing in what you don't understand. Ask whether this fits your long-term strategy and goals. Recognize that for every winner you hear about, there are many silent losers. Accept that you'll miss some opportunities, and that's fine. Your strategy doesn't require catching every trend. It requires avoiding catastrophic mistakes. The difference in outcomes: the noisy response often results in buying near a peak and experiencing significant losses. The clear thinking response means missing some gains but also avoiding significant losses. Over time, avoiding big losses matters more than catching every gain. Example 3. Conflicting advice. One expert says stocks are overvalued and recommends selling. Another says the bull market has years to run. One article warns of inflation. Another warns of deflation. You're confused about what to do. The noisy response: try to determine who's right. Read more articles and watch more interviews to find the answer. Feel increasingly confused as you encounter more conflicting views. Eventually, make a decision based on whoever was most recent or most convincing, not on actual analysis. Change your strategy based on external opinions. The clear thinking response: recognize that predictions are largely worthless and that conflicting expert opinions are normal. Instead of trying to figure out who's right about the future, focus on what you can control. Your savings rate, your costs, your diversification, your time horizon. Build a strategy that works reasonably well across different scenarios rather than betting on one prediction being correct. Ignore the noise of conflicting predictions and focus on principles. The difference in outcomes: the noisy response leads to constant strategy changes and reactive decision-making. The clear thinking response leads to consistency and allows compounding to work over time. These examples illustrate a pattern. Noise pushes you toward action, reaction, and emotion-driven decisions. Clear thinking leads to patience, principle-based decisions, and often doing nothing. Over time, this difference compounds dramatically. One of the most important aspects of thinking clearly about money is understanding what you can control and what you cannot. Noise constantly pushes your attention toward things you cannot control: market movements, economic conditions, what others are doing, future events. Clear thinking focuses your attention on what you can control. You cannot control market returns. You can control how much you save and invest. You cannot control whether individual investments succeed. You can control your diversification. You cannot control economic cycles. You can control your debt levels and emergency reserves. You cannot control what others achieve. You can control whether you stick to sound principles. This distinction matters because effort directed toward things you cannot control is wasted and often counterproductive. When you try to predict market movements or time the market, you're trying to control the uncontrollable, and you'll fail more often than you succeed. When you focus on your savings rate or your investment costs, you're controlling the controllable, and your efforts produce reliable results. The noise wants your attention on the uncontrollable, because that's where fear and uncertainty live. And fear and uncertainty drive engagement. Clear thinking means constantly redirecting your attention from the uncontrollable to the controllable. Every time you find yourself worried about market movements, redirect to asking whether your savings rate is where it should be. Every time you're tempted to make predictions about the economy, redirect to asking whether your emergency fund is adequate. This focus on the controllable is psychologically liberating. When you accept that you cannot control markets or economic outcomes, you stop feeling responsible for them. You stop feeling anxious about things you cannot change. You focus your energy where it can actually make a difference. This reduces stress and improves decision quality simultaneously. Let's discuss the relationship between clear thinking and long-term success. This is not incidental. Clear thinking is not just pleasant or admirable. It's essential for achieving good financial outcomes over a lifetime. The reason is that financial success is mostly about avoiding mistakes rather than making brilliant moves. The mathematical reality of investing is that a few large losses can destroy years of gains, while avoiding large losses and achieving reasonable returns reliably leads to wealth through compounding. Clear thinking helps you avoid mistakes. Clouded thinking leads to mistakes. Think about the major financial mistakes people make: panic selling in market downturns, taking on excessive debt for depreciating assets, investing in things they don't understand, chasing trends at market peaks, making emotional decisions, failing to diversify, paying excessive fees. All of these mistakes stem from clouded thinking, from allowing noise and emotion to drive decisions rather than rational analysis. Clear thinking doesn't guarantee you'll make the best possible decisions. You'll still make mistakes. But clear thinking helps you avoid the catastrophic mistakes that destroy wealth. It keeps you from being your own worst enemy. And over decades, avoiding catastrophic mistakes while making reasonable decisions is the path to financial success for most people. Consider two investors over 40 years. One has brilliant insights occasionally, but also makes significant mistakes driven by noise and emotion. The other never has brilliant insights, but maintains clarity and makes solid, boring decisions consistently. The second investor will almost certainly end up wealthier because avoiding big mistakes matters more than occasional brilliance. This is why we emphasize clarity so strongly. It's not just about feeling calm or being intellectually satisfied. It's about achieving better financial outcomes over your lifetime through better decision making. If you follow this discussion, you understand that clear thinking about money is both essential and difficult in our noisy world. It requires active effort to protect your attention, structure your environment, and maintain discipline. But this effort is worthwhile because clarity compounds over time into dramatically better decisions and outcomes. This channel exists to help you develop and maintain this clarity. If you value rational analysis over hype, timeless principles over trends, and honest examination of what actually matters, I'd appreciate if you like this video and subscribed for more content in this vein. There's no promise of quick wealth or secret strategies here, just thoughtful exploration of how to think clearly about money and investing in a world designed to prevent clear thinking. Let me close with a final thought about what clear thinking about money ultimately means. It means having the intellectual independence to think for yourself rather than being blown around by every wind of opinion. It means having the discipline to focus on what matters rather than being distracted by noise. It means having the confidence to be different from the crowd when the crowd is wrong. It means having the humility to admit uncertainty and structure your decisions accordingly. These qualities, independence, discipline, confidence, and humility, are valuable far beyond finance. They matter for career decisions, for relationships, for how you spend your time, for how you live your life. Money is just the domain where these qualities are most easily measured and where their absence is most costly. The world will continue to be noisy. In fact, the noise will probably increase as technology makes it easier to capture attention and as more parties compete for your engagement. Financial media will remain incentivized to create anxiety and urgency. Social media will continue to generate comparison and inadequacy. Product providers will keep marketing sophisticated solutions to problems you don't have. Your own psychology will continue to create biases and emotional responses. None of this will change. You cannot control the noise. What you can control is whether you allow that noise to cloud your thinking and drive your decisions. You can control your information environment. You can control your decision processes. You can control where you direct your attention. You can control whether you think clearly or allow yourself to be overwhelmed. This control is what separates successful investors from unsuccessful ones over long periods. It's not intelligence or information access or luck. Though all of these play roles, it's the ability to maintain clarity despite constant pressure to abandon it. It's the discipline to focus on principles when everyone else is reacting to news. It's the independence to think differently when different thinking is correct. Most people never develop this clarity. They remain subject to noise throughout their lives, making reactive decisions, chasing trends, panicking in downturns, and wondering why their financial results are mediocre despite their efforts. They're not failing because they're stupid. They're failing because they cannot think clearly through the noise. You can be different. You can develop systems that protect your clarity. You can cultivate independence of thought. You can focus on what actually matters. You can make decisions based on principles rather than noise. And over decades, this difference will compound into dramatically different outcomes, not just financially, but in terms of peace of mind, confidence in your decisions, and freedom from financial anxiety. The choice is yours. The noise is not going away. The question is whether you'll let it control you or whether you'll develop the clarity to see through it. Whether you'll be reactive or deliberate. Whether you'll be driven by fear and greed or by rational assessment of your goals and circumstances. Whether you'll make decisions you'll regret or decisions you can maintain conviction in through inevitable periods of difficulty. Clear thinking about money is not just a nice-to-have quality. It's the foundation of financial success and psychological peace. It's available to everyone, but practiced by few. It requires effort and discipline, but the rewards compound over a lifetime. The world is noisy. Your thinking can be clear. That's the opportunity and the challenge. That's what separates those who build lasting wealth from those who struggle despite trying. That's what this entire discussion has been about. Think clearly. Focus on principles. Ignore the noise. Control what you can control. Be patient. Be rational. Be independent. Over time, these qualities will serve you better than any specific strategy or tactic. They'll serve you in investing and in life. Thank you for watching. Now go create the quiet space needed for clear thinking and protect it fiercely.